Hey there. Welcome to our deep dive into machine learning for algorithmic trading. It's a field that's both fascinating and intimidating. Kind of like trying to teach a robot to play poker. But don't worry, we're here to break it down for you, using machine learning for algorithmic trading as our guide.
Yeah, it's a field where the lines between finance and technology are really starting to blur, and those who can master both definitely have a huge opportunity here.
All right, so let's start with the basics. We're talking about using computers to make trading decisions, but not just any old computer program. We're talking about algorithms that can actually learn and adapt.
Right, exactly. It's about building systems that can just go through massive mountains of data, identify patterns that humans might miss, and then they use those insights to make those smart trading decisions.
Okay, I'm intrigued. The Rilke mentioned some pretty interesting examples, like using satellite images to predict company performance. Is that actually a thing?
It is. If you think about it, you're looking at satellite images of a retail giant's parking lot. You can actually track how busy those lots are over time, which can actually give you clues about the company's sales before they even release their earnings reports.
Wow, that's some next level stuff. So basically, we're not just talking about crunching numbers in a spreadsheet anymore. It's about finding creative ways to use data and kind of get an edge.
Right. And that's where the real power of machine learning comes in. These algorithms can analyze all sorts of data, from the traditional market data like prices and volumes, to some alternative data like news sentiment, social media trends, even weather patterns.
All right, my mind is officially blown. But let's back up for a sec. Before we can even start building these algorithms, we need data, right? And not just any data,
Mhm.
but good data. What's the key to finding and actually using the right data?
You know what they say, garbage in, garbage out really applies here. You can have the most sophisticated algorithm in the world, but if you're feeding it bad data, it's going to spit out bad results.
So how do you make sure you're not just sifting through a pile of digital garbage?
Well, it starts with understanding the financial markets and knowing what types of data are actually relevant to your trading goals. Are you trying to predict short-term price movements, or are you looking at long-term trends? Different strategies require different data sets.
So domain expertise is still super crucial. It's not just about handing over the reins to the machines.
Absolutely. You need to be able to ask the right questions, interpret that data, and ultimately you're the one who's making the final trading decisions.
Now, the book Machine Learning for Algorithmic Trading seems like a pretty dense read. Does it actually dive into the nitty-gritty of how to build these algorithms?
It does, but it also does a really good job of taking complex concepts and breaking them down into manageable chunks. And what's cool is that it has a lot of practical examples and Jupyter notebooks, so you can see the code in action and experiment with it yourself.
That sounds really helpful, especially for someone who's maybe just starting out in this field. But even with the good data and the right tools, there's still a lot that can go wrong, right?
Mhm.
I mean, the market is a pretty unpredictable beast.
True. One of the biggest challenges is trying to avoid overfitting, where your model performs perfectly on historical data, but then it completely falls apart when it actually faces some new market conditions.
So it's like training a racehorse on a perfectly flat track
Yeah,
and then expecting it to win the Kentucky Derby with all of its twists and turns.
exactly. You need to be able to build models that can generalize well and adapt to those changing circumstances. And that's where things like cross-validation come in.
Cross-validation, fill me in.
So it's basically a way to test your model on different subsets of your data to make sure it's not just memorizing patterns, but actually learning the underlying relationships. Think of it like giving your model a series of pop quizzes just to make sure it's understanding the material.
So we're trying to train our algorithms to be less like rote memorizers and more like flexible thinkers, able to adapt to whatever the market throws at them.
Precisely. And that's just one piece of the puzzle. Once you have a model that's performing well in testing, you still need to figure out how to translate its predictions into actual trading decisions.
Right. It's one thing to have an algorithm that says, hey, this stock is likely to go up. It's another thing entirely to know how much to invest, when to buy and sell, and how to actually manage your risk.
Exactly. That's where the art of trading meets the science of machine learning, and that's what we're going to be exploring in more depth in the next part of our deep dive.
Okay, so we've built our machine learning model, we've tested it, and it's spitting out some pretty promising predictions. But now comes the real challenge, actually putting it to work in the wild world of trading. Where do we even begin?
Well, think of it this way. You've got this brand new sports car capable of incredible speed and precision,
Yeah.
but if you just floor it on a busy city street, you're going to end up in a lot of trouble. You need a skilled driver, someone who understands the rules of the road, the nuances of handling, and how to anticipate those potential hazards.
So our algorithm is like the sports car.
Yeah.
And we need to be the experienced drivers who can harness that power
Mm,
without, crashing and burning.
exactly. One of the first things we need to think about is how to integrate our model's predictions into our overall trading strategy. Are we going to let the algorithm make all the decisions, or are we going to use it more as a tool to help inform our own judgment?
So it's not necessarily about just completely handing over control to these machines. It's about finding the right balance between those data-driven insights and that human intuition.
Right. Some traders prefer to just use machine learning to identify maybe some potential trading opportunities, but then they use their own experience and market knowledge to kind of make that final call on whether to actually enter a trade. Others might give their algorithms a bit more autonomy and set some specific rules and parameters for them to follow.
The book talks about a technique called walk-forward analysis, which seems like a more sophisticated way to backtest these strategies.
Right.
What's the advantage of that?
Yeah, so walk forward analysis. It's like giving our algorithm a series of simulated test drives before we let it loose on the real racetrack. Basically, it allows us to see how our strategy would have performed over different time periods, using only the data that would have been available at that time.
So it's a way to check if our model can actually adapt to those changing market conditions, not just kind of memorize past patterns.
Exactly. Another key aspect of real-world trading is risk management. It doesn't really matter how sophisticated our algorithm is, there's always a chance that it could make a bad call. And we need to have safeguards in place to protect ourselves from those potentially catastrophic losses.
Okay, that makes sense. But how do you actually manage risk in the context of algorithmic trading?
Well, one of the most important principles is diversification. We don't want to put all of our eggs in one basket, especially when we're relying on an algorithm that can behave in unpredictable ways. So instead of betting everything on a single stock or asset class, we spread our risk across a variety of different investments.
That sounds like classic investing advice. Don't put all your eggs in one basket and all that.
It's a timeless principle for a reason. It's just as relevant in the age of algorithms as it was back in the days of pen and paper trading.
What about position sizing? How do we decide how much to invest in each trade?
That's where things get a bit more technical. We need to consider factors like our overall portfolio size, our risk tolerance, and the volatility of the asset that we're actually trading. There are some formulas and algorithms we can use to help us determine the optimal position size for each trade, but ultimately it comes down to making calculated decisions based on our individual circumstances and risk appetite.
So even with algorithms crunching all those numbers, there's still a lot of human judgment involved in successful trading.
Absolutely. We need to be able to interpret the data, make adjustments to our strategies, and ultimately take responsibility for our own decisions.
You mentioned a few times that algorithmic trading can be kind of unpredictable.
Yep.
What are some of the common pitfalls that traders can fall into, even with the best intentions and the most sophisticated algorithms?
One of the biggest mistakes is over-relying on those backtesting results. Just because a strategy performed well on historical data, it doesn't actually guarantee that it will continue to perform well in the future.
So we can't just set our algorithms loose and expect them to print money.
Definitely not. The market is constantly evolving. What worked yesterday might not work tomorrow. We need to be constantly monitoring our algorithms, making adjustments, and really just staying ahead of the curve.
It sounds like a lot of work. What kind of personality traits or skills do you think are essential for someone to really succeed in this field?
Well, obviously you need a strong understanding of both finance and technology, but beyond that, I think the most important qualities are intellectual curiosity, adaptability, and a willingness to constantly learn and evolve.
So basically, you need to be comfortable with the idea that you'll never really master this field because it's always changing.
Exactly. It's a continuous journey of exploration and discovery, and honestly, that's what makes it so exciting.
This has been super insightful. I'm really starting to see how machine learning can be a powerful tool for traders, but also how it requires a lot of careful planning, risk management, and just that ongoing adaptation.
Yeah, it's definitely not a get-rich-quick scheme, but for those who are willing to put in the time and effort, it can be an incredibly rewarding and intellectually stimulating pursuit.
Well, on that note, I think we've covered a lot of ground in this part of our deep dive. We talked about integrating algorithms into our trading strategies, managing risk, and some of the common pitfalls to avoid. But there's one more aspect of algorithmic trading that I think we need to address before we wrap things up.
And what's that?
The potential impact of all this on the markets themselves. I mean, if more and more people are using algorithms to trade, does that actually change the way the markets behave? Does it make them more volatile, more unpredictable? We'll delve into those questions in the final part of our deep dive. So we've spent the last couple parts of this deep dive really digging into how to build, test, and actually use these machine learning algorithms for trading. But now I kind of want to shift gears a little bit and think about the bigger picture. How is all this algorithmic activity changing the markets themselves?
That is the million-dollar question right now. A lot of people are asking that. As these algorithms get more and more sophisticated and they become more widespread, they're definitely having a significant impact on market dynamics.
Yeah, I imagine it's kind of like introducing a new species into an ecosystem.
Right.
Right. You got to wonder how it's going to interact with all the existing players.
Yeah.
And whether it's going to throw things out of balance.
Yeah. It is a great analogy. One of the most common concerns is that all this algorithmic trading can actually increase market volatility. When you have a lot of algorithms all reacting to the same signals at the same time, it can create this feedback loop and drive prices up or down way faster than any human could ever react.
Yeah, we've seen some pretty crazy examples of that in recent years.
Yeah.
Right, with those flash crashes and sudden spikes in volatility that seemingly come out of nowhere.
Right. And while it's really tough to say for sure that algorithms were entirely responsible for those events, they for sure played a role. The challenge is that they can process information and execute trades so much faster than us humans, which can amplify both positive and negative market movements.
So it's almost like having a bunch of super fast race cars all trying to navigate a really crowded track at the same time. The potential for some serious collisions is definitely a lot higher.
For sure. And then another concern is that all this algorithmic trading could lead to a decrease in market liquidity. If everyone's relying on the same algorithms, and those algorithms are all basically programmed to buy or sell at the same price points, it could get a lot harder to actually find a buyer or a seller when you actually need one.
Yeah, that sounds like it could create some pretty wild swings in prices, especially if everyone just decides to head for the exits all at the same time.
It's definitely a risk.
Yeah.
And it's one that regulators are definitely keeping a close eye on. They're trying to find that balance between encouraging innovation in the space, but also making sure that markets remain fair, orderly, and transparent.
Sounds like a tough balancing act.
Yeah.
How do you actually regulate something that's constantly evolving and becoming more and more complex?
It's not easy. One approach is to really focus on transparency and disclosure. Regulators want to understand how these algorithms actually work. What kind of data are they using? How are they actually making those decisions? They also want to be able to track all that algorithmic trading activity and identify any potential market manipulation.
So it's kind of like holding up a magnifying glass to that black box of algorithmic trading, trying to figure out what's going on inside.
Right. And it's not just about regulation either. The industry itself has a big role to play in promoting some of those responsible algorithmic trading practices. Developers need to build safeguards into their algorithms to help prevent any unintended consequences. And traders need to be using these tools responsibly, with a clear understanding of the risks involved.
Sounds like we're all still kind of figuring out how to navigate this new landscape. It's kind of exciting in a way, but also a little bit scary.
It's definitely a time of rapid change and a lot of uncertainty. But one thing's for sure, the rise of algorithmic trading is transforming the financial markets in some pretty profound ways.
Well, I think we've definitely given our listeners a lot to think about in this deep dive. We've covered a lot of ground, from those technical details of building machine learning models to the broader implications of algorithmic trading for the markets as a whole.
Absolutely. We've seen how these algorithms can be really powerful tools for traders, but also how they come with their own unique set of challenges and risks.
As a final thought, I'd encourage our listeners to keep exploring this fascinating and ever-evolving field. The future of finance is becoming more and more intertwined with the world of technology. And those who can adapt and innovate are going to be the ones who really thrive. Thanks for joining us on this deep dive.